This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, as always. Today, we are pleased to welcome on Randy Smith with Impact Equity. We're going to be doing this as a two-part episode, so we're going to be kind of going over a lot of things as it relates to raising capital and what that means for many different avenues of investments, specifically as it relates to commercial real estate and that whole wonderful world. So, Randy, thank you so much for being on with us today. If you wouldn't mind, give us a little bit of a background about yourself. Some things that I've kind of noticed in the real estate space is rarely does anyone kind of go to school and they decide they're going to be in real estate. Although the gentleman I interviewed yesterday for doing, we went through a really interesting topic of discussing heavy industrial real estate syndications, actually did go to college with the idea of going directly in real estate. So
okay,
him being an outlier, give us a little bit of background about how you kind of came to be where you're at with Impact Equity and a little bit about yourself.
Yeah, absolutely. And first of all, thank you for having me on the show. I'm super excited to be here with you and the audience. It is, I'm actually a member, a client, participant in the things you guys are doing with the organization. So thank you for having me on the show. So as you mentioned, my name is Randy Smith. I'm the founder of Impact Equity. I actually got into the real estate space 5, 6, 7 years ago, I guess, finally, after many, many years of sitting on the sidelines. I was in corporate America as a W-2 sales guy for about 25 years. I spent the last 20 years with two different stints in very large Fortune 100, Fortune 200 organizations. Both instances ended in layoffs after 10 years with each organization. So about 5 years before leaving my W-2, I finally made the plunge and started investing in real estate as a means to help to decrease my dependence on my W-2 income. And I bought a couple of turnkeys out of state, and then I bought and executed some BRRRR strategies in Atlanta, and found pretty quickly that those were not really passive investments at all. In fact, it was more like a part-time job that ended up taking up more and more of my time, and finally made the decision to shift over into the passive investing space as a limited partner. And after doing that for a couple of years, I ended up getting laid off once again. And fortunately, at that point, I had created enough passive income that offset a large portion of my monthly expenses, so I didn't have to run out and go chase another W-2 job. So that's when Impact Equity was born. That's when I went all in on passive investing and teaching others how to do it. And that's kind of what got me here today.
Yeah, it's definitely a common core of, what people, identify. A lot of them, it's easy to start out in single family because it's, on the spectrum of things, it's the small fish in the pond. It's, you can see a house in front of you. It's like, okay, I can kind of understand this, but you're right. It is a lot of work for, looking on the scale of what you can make in real estate. It's a lot of work for, very little output. You have put in all this work to get one door, one rental stream, or one flip, as opposed to putting in, maybe 2 times the work for a commercial piece of real estate, whether that is light industrial, commercial multifamily, but you get a multiple on that. It's 10 doors, 15, 3 long-term commercial tenants, 1 extremely long-term 30-year lease on a heavy industrial side. There's a lot of things that kind of go into, again, the throughput and the return on your time investment that was kind of echoed by a lot of people. So again, I like to kind of whenever we have commonalities between a lot of people, especially people that have had success, I like to make sure I kind of address that and kind of make sure it's like saying, hey, like, here's the low-hanging fruit of things to take away from this. If you're here to educate yourself, definitely a good thing to take away from it. So again, you board that kind of being your trajectory into where you are now with Impact Equity. What's kind of your investment thesis at Impact Equity? People do a lot of different stuff in the commercial space. What do you do, and what's kind of your investment philosophy at Impact?
Yeah, great question. So, I mean, ultimately, my investment thesis with impact equity mirrors very closely my personal investing strategy as well. So, ultimately, our goal with impact equity is to provide our investors with diversification across asset classes, markets, geographies, operators, and deals, and essentially provide kind of a one-stop shop for diversification in the passive investing space. So, what that looks in application is that I have two operators that I work with that are in the probably B, C class multifamily value add space. And I've got one operator that is a short-term rental fund that is purchasing assets across 10 different states, very high-end, high-finish short-term rentals with really, really amazing design that drives an experience to the folks that end up staying at these units. So it's a way for investors to place capital in multiple deals, get access to diversification, and know that their dollars are being taken care of, and we're putting those dollars with good stewards. So
Fantastic. So the main topic that we had discussed on bringing up today, and kind of again splitting this into a two-part series, is real estate is many things, but cheap it is not. And it's as corny as that sounds, I say that a lot, but it holds true. And if you can kind of identify the easy things, the harder things become slightly easier as well. So with it being expensive, the need to raise capital is kind of paramount in any of these deals. You could have a great operator or a great deal that comes across your desk, but if you can't generate the capital to take it down or acquire it, then you might as well just light the paper on fire. It really does nothing. So the aspects of raising capital is kind of a big hurdle that a lot of people need to address. Now, it's again easy enough to wrap your mind around going to people that you have capital and say, hey, I have a deal, give me money. But it's not as simple as that. And it also doesn't necessarily kind of put a good taste in people's mouth when you just go up and say, money please. There needs to be some best practices that go along with that. And that's really kind of what we want to focus on is when it comes to raising capital, what are some of the best practices going on out there? You need to, what should you have? What should you look for? How do you kind of bring these things to other people to say, hey, I have something good here. And make it look good to those people. So let's kind of dig into that a little bit, if you would. So again, when someone says, what are the best practices of raising capital? Let's start from the top and work our way down. What does that look like to you?
Yeah, and I think it can be, at least we can start the conversation with my journey from W2 into the capital raising space, because early on, I did not know that capital raising was something that I was going to do. I knew that I wanted to get more involved and potentially find a way to spend my days and hours helping people in this space. But I wasn't quite sure what that was. So when I got laid off the last time, I just started reaching out to my network and talking to everybody that I knew in the space. And one of the people that I spoke with was one of the operators that I had invested very heavily with. I think I had invested in 5 or 6 deals with them over the last couple of years, and I had had a lot of success. I had had a full cycle deal with them, so I was a big fan of what they were doing. Being a guy that was in sales for 25 years or so, I am very much a guy that when I'm doing something that I'm excited about, I shout it from the mountaintop. Everybody within shouting distance knows what I'm doing. So the year leading up to me leaving my corporate America job, I had actually referred about $1 million worth of capital to that operator. So when I had the conversation with him in conjunction with 8 or 10 other conversations that were all kind of going in the same direction, the thought came up that maybe capital raising would be a good way to do that. So essentially that partner offered me the opportunity to present a deal to my investors. He would provide essentially business in a box to me. And if it went well, great. If it didn't go well, then he would cover some of the kind of fixed costs that were associated with it. And then I would go on my way. So, a couple of weeks later, we got all the legal stuff in place and I launched the deal, and I was able to raise almost $1 million in just a couple few weeks. And I did that through a couple of different strategies, that we can get into further, but that's kind of how that process started, and how ultimately I got into the space.
Oh, awesome.
today.
It's definitely
Yeah.
always good to understand where, especially people that are speaking as, subject matter expert, understanding kind of where they came from to understand kind of how they're answering the questions. Because you can ask, 10 different people and get 10 different answers on the best practices of doing something, and they all very well may be good, but understanding kind of where you come from, I think, is important. So, let's start off with kind of the high level strategies that
Yeah.
go into it. Again, let's kind of start from the top and what you kind of feel are the most important and maybe easy to grasp, and then work our way more towards the slightly more ethereal, a little bit more nuanced things that people should be looking at.
Yeah. Yeah. So, I mean, ultimately, if you're going to raise capital, everybody in your network needs to know what you're doing. So how do you do that? How do you make sure, do you pick up the phone and just dial everybody in your phone? Do you, do some big announcement on social media? Do you, get billboards in the city that you live in, whatever it is? You've got to pick a path and ultimately just get in front of your audience. And what I did, I actually, I had found that when I got on the phone with people, I was actually pretty successful in sharing the story and discussing the benefits of it, and people would get excited about it. So my thought was, how do I actually get as many people as possible on the phone to have that discussion? And the thought came to me at an event that I was at, that if I could just message everybody that I had in LinkedIn, because I had been leveraging LinkedIn for 20 years in my sales job. So these were people that already knew, like, and trust me, because they were either colleagues or people I had done business with, or I had prospected very heavily. So I ended up hiring a guy off of Fiverr, or, actually it was Fiverr, but it's similar to Upwork. I think I paid the guy $40 to send a message to all of the people that I had been connected with in LinkedIn. And I included a very short kind of recap of, not sure if you're aware or not, but I recently left XYZ company, and this is what I'm doing. Let me know if you want to connect. And I booked my calendar for like 2.5 weeks, and kind of the rest is history at that point. So the thought that if I could just share the story, kind of my journey with passive investing with folks, then they might get excited about it and also want to engage. And that's actually
Sure.
what happened.
And that brings up kind of a really good point, is that, using your existing network, but, we would be remiss if we didn't kind of cover some of the issues that could, potentially arise from that. So, when it comes to raising capital, especially for private deals, it's as attractive as a deal may sound, you have to be cognizant of the law and making sure that you're not violating or, crossing any boundaries there. So I
Yep.
think it's kind of important to look at of like how people go about doing that. Like you said, you left it very vague, right? You said, hey, here's what I'm doing now. If you want to connect, great. Because you have to definitely be careful of some of the stuff that you might put into something like that. You couldn't necessarily put, hey, I have, this, and really drill down. So, how
Yeah.
vague do people need to get it? Where's kind of the sweet spot if you're going to kind of use that network, kind of that, like my term, kind of that social network that you have to
Sure.
try to get interest and then have those further conversations, because you can't just put in, hey, I guarantee, an 8% pref with an X, Y, and Z to these
Yeah.
people.
Yeah.
How do you kind of approach that and stay on the right side while still being engaging enough?
Yeah, so you bring up a really good point. So there are, for educational purposes, there's really two main types of investment opportunities, 506Bs and 506Cs. 506Bs, you can only share with your existing network, and you cannot advertise it publicly. 506C, you can advertise to the broader market, and you can basically share, you can share the deal on LinkedIn, Facebook, Instagram, whatever that is. So if you're talking about your specific network, there's a couple of things that come into play there, where one, you need to have a pre-existing and substantive relationship with that person in order to share it with them. So just connecting with somebody on LinkedIn does not mean that you have a pre-existing and substantive relationship. There's a number of different definitions for it. I would encourage you to talk to an SEC attorney and find out what's comfortable for you. But come up with a strategy that you feel comfortable with that satisfies the SEC requirements. But in a general way, you can actually go on social media and say, I am a real estate investment firm, and these are the types of things we do. We can't share specifics about deals. We can't share metrics. We can't even say, we'll double your money in 5 to 7 years. You can't even say general things like that to a broader audience. So it's you are not allowed to solicit in those environments. So I think if you have a relationship with the folks, then it's really just trying to create a call to action to continue the conversation and then make sure that you satisfy all the requirements before you do actually present a deal to them. So the guideline that I use currently is that I need to have had a phone conversation with my particular contact. I need to have multiple interactions with them over the course of 30 days. And then at that point, any deals that I have available after I've satisfied that they have a sophistication level that meets the requirements of the SEC, then I can share an opportunity with them as a 506B. So again, it's if you ask 10 different SEC attorneys what the guidelines are, you're going to get 10 different answers. So I would just encourage you to talk to a few and come up with a policy and then run that policy past a couple of different SEC attorneys just to make sure that it satisfies that.
Yeah, and I would also add on to that, especially kind of coming from the world that we do in, financial record keeping, is keep records of this stuff. If the last thing you want to do, especially if you're trying to raise capital, is if the worst ever does happen, you want to be able to say, hey, look, I followed my policy and procedure. I had it examined by someone. We did not deviate from this. If we did deviate, it was to the it was to the tighter degree, not the looser degree. Saying, we shaved a business day off here. It's like, no, you want to add, an extra business day onto that relationship, again, to be more substantive. But again, what I try to tell people on anything is that record keeping is great. You really want to make sure you're able to do it and be able to kind of follow those established policies and procedures. Because, at the end of the day, if you're, breaking the law, in any sense, that doesn't bode well for you being a good steward of someone's capital if you're trying to get their money into your deal. So, again, kind of the two broad strokes to paint with is that I think the things to take away from are kind of understanding what you're raising capital for. If you're not necessarily the one that put together the whole deal and you're coming in using a skill set to help someone else raise capital, understanding the difference between a 501c3 and a 501b or 506b. As it relates to how you can solicit those investors and what you can say after how long. Again, best practices, the people on the other end may not even necessarily kind of understand or care so much about that, but you would be remiss if you're not acting in good faith. So understanding kind of how, you do that and, to your point, get that together before you start doing this and then run it by some SEC attorneys. Now, are there any good specific questions to ask, like anything that you have experience in asking, having those conversations when you kind of built your, thesis of how you're going to go out and try to raise capital? Any kind of points or good things to ask an SEC attorney if they're going to go out and try to get some good advice on how to start raising capital for people?
Boy, that's a difficult question, and you got to be cautious with how much you ask, because at $350 an hour, it adds up pretty quickly. So, what I would actually encourage folks to do is do some online research and listen to a lot of folks that are doing this, and jot down the questions that you have, and then bring those to an SEC attorney. I met with somebody just recently that said that they started raising capital and they spent like $70,000 getting the fund set up because they literally wanted to be walked line by line through a PPM. They wanted to tailor make a PPM, and it's just not necessary to do that. So PPMs can get built for $5,000, $8,000, $10,000, $12,000, and all the way up to $70,000 apparently. But you don't have to spend that much to get started in this space. So there's a ton of material that is available for free. If you just did capital raising search in Google for private placements, you would come up with a ton of information, and then dig into that and start to build your own strategies, and then bring those strategies to an SEC attorney and ask whatever questions you have at that point. So, the big question I think at first is, do you want to raise from non-accredited investors, or do you want to raise from only accredited investors? And that's a big one. I'm not sure exactly what the stat is, but I heard an SEC attorney at a conference recently share that I want to say it was like 90% of all private placement deals are actually 506Bs. You just don't know about them because they're not advertising them, and they're deals that happen, like country club style deals, because it truly is friends and family that are only dealing with those. The Grant Cardones of the world and all of the big deals you see published all over the place are 506Cs, but they only take accredited investors and and they're able to go out there and advertise all over the place. So decide what you want to do and which kind of avatar you want to pursue, and then pick the right type of exemption, essentially, to leverage for your raising needs. So
From your standpoint, are there any kind of high level things that you would say would be a benefit to going one way versus another? Is one easier to reach? Is one harder to reach? Are there any kind of constraints or, again, benefits just at a high level that you would think, from looking at kind of building your portfolio or building your book of how you want to do this and best practices, that you would say one versus the other? Or is it kind of specific to the industry and the thesis of your investment strategy?
Yeah, so I think it more comes down to the individual that's doing the raising and what do their personal resources look like. Myself, I was in sales for 25 years, and I have a humongous network of people that I've worked with, done business with, prospected for years and years and years and years. So I already had a very large network. But if you're a younger individual that doesn't have 20 years of work experience and networking and been involved with clubs and organizations and things like that, you're probably going to need to advertise to the general public. So that would dictate whether you went 506 or 506C or B. Now, there are some options where people are doing these conversions from a 506B to a C. So you'll see people share it with their personal network to allow non-accredited investors to come into their opportunities, and then they actually convert it into a 506C so they can advertise to chase the final dollars. But that's a little more complex. It costs more money. I think it opens you up to some clients-related issues that you wouldn't have if you went with one or the other. So I think it's just really important to take a look at what are your strengths, what are your resources, and what is the business plan, and then make the decision from there. And an SEC attorney can help you navigate through those questions to make sure you're staying in compliance.
Fantastic. So let's get into a little bit more down to the actual conversations you have with people. Again, there's painting with a high level, a broad brush is, kind of understanding, what qualifies you to be able to have the conversation that's deal specific. And once you kind of get there, what are some things that you would say, it's, you don't want to necessarily just come out of the gate and say, like, it's so great, 1, 2, 3, 4, 5, you should invest with me now. This stuff has to be a little bit more nuanced, especially when you're asking someone for, $50,000 a share, 25,000, whatever you're demarcating it at. What's kind of the way to ease people into that? And, everyone's going to have their own kind of flavor of how they do it. I know in my role at sales, like, I have a way I do it, which is different from my other colleagues. Not to say that it's better, or worse, but, what are some things, again, that people can, take away on a high level that would be a good way to kind of start doing that, and how you can kind of broach these conversations of asking people for money?
Yeah. So I think at the end of the day, it's a conversation. It's not, you hear a lot of people with really fancy scripts. They spend a ton of time building scripts. In all my years of sales, I have not been a big fan of scripts. I'm a big fan of having a conversation with another human being. And at the end of the day, the goal is to have an understanding as to what it is that they're actually trying to achieve versus you trying to shove some product or solution down their throat. So if you can have a conversation that gets them talking about what interests them in real estate, what brought them to this space, what are their long-term goals with their real estate investing, the desires that they're trying to achieve, that's going to tell you first and foremost, one, if they're even qualified to participate in this type of investment, and two, it gives you an idea as to whether the type of offerings you have are even a good fit. So I like to start conversations, one, just like you and I did, like, tell me a little bit about yourself. I'll tell you a little bit about myself, right, and my journey. And then really get into understanding what their investing experience has looked like up to this point, as well as their career experience. That can actually take me down a path to have an understanding if this is a accredited investor, if it's a sophisticated investor, do they meet the criteria that I'm going to need in order to move forward? And, like any salesperson that's worth their weight at all, they're going to be asking open-ended questions. So tell me about a time, or explain to me this, or help me understand, or those type of open-ended questions to get them talking. And then the conversation will steer from there. And once you get a good understanding that they're a fit for what it is you're offering, then you can start talking about potential opportunity types that could be available to them. So I stay away from scripts because I've been on the other end of scripts far too many times, and they're too impersonal and transactional. And at the end of the day, I'm trying to build a relationship with somebody that will invest with me time and time and time again, for the next 10 or 15 years, ultimately, because that's the goal. Transactional investment is not something I'm interested in, and I don't think it serves the investor as well.
Yeah, no, I think that's a great point. And to the slightly antithetical point of that is that if scripts work for you, great. But again, I think talking to a lot of successful salespeople and people that have done this for a long time, develop your own flavor of this. You can certainly build off something that's script based, but realize that the people that you're talking to are not just an AI bot. It's a real person that wants to have a real conversation with someone that understands, and not to say that you can't understand something using a script, but having that real, for lack of a term, just a real conversation with someone, I think is good no matter what you're trying to sell, whether it's raising capital for your investment, whether it's selling a widget or self-directed IRAs. It's it's just something that it's good to be able to be conversational with. Now, every person you're going to talk to is not necessarily always going to be a good fit. Now, I think it's kind of good for people to maybe understand is that, yes, let's say someone, obviously if someone doesn't have any money, they're not a good fit to invest because they have nothing to invest. But on a higher level, what are some things that might come up? Let's say someone has, a bunch of money. Let's say they are accredited and they're like, okay, great, sounds good. What are some things that might make you either pause, steer clear, just say, hey, I don't think this is a good fit because, not all money is good money, when it comes to dealing with these people. And not to say that they're a bad person on the other line, but, what are some things that, maybe, again, high level that people might want to watch out for if they're talking to someone that says, hey, maybe we should give a pause or maybe I shouldn't necessarily take this further with a particular person they're trying to raise some capital from?
Yeah, I think one thing that's kind of a big red flag for me is when I get on the phone with somebody and they've got a gazillion questions and they're questioning every minute detail of every disclosure that's ever been shared with them, or two, they're not asking any questions at all and they're ready to jump in and invest a very large amount before there is any type of relationship that exists. So I think both are kind of watch-outs for me. One, I've had folks that commit and then want to pull their dollars back, which can be kind of complicated. I've had folks that have buyer's remorse, which makes complications, and it's not something that I want any of my investors to go through. So I would rather take the time to walk through the process and make sure to educate along the way to make sure that there's no surprises for them throughout the process. So I think those are a couple of things. I think it's important too to get a really good understanding as to when we go back to like what's driving this. Are these folks looking for growth opportunities? Or are they looking for cash flow opportunities? I made some mistakes early on where I put capital into deals and I didn't even really know what it was that I was trying to achieve with it. I just knew I wanted to be in real estate, and I wrote a big check on my first deal. And in hindsight, it was the wrong business model. It was the wrong return metrics that I was looking at. And quite frankly, I wish I would have diversified across more deals than putting, a six-figure check into one investment. So again, it just comes back to that really getting to know the person and understanding what they're trying to achieve. And if they won't allow you to do that, then sometimes you got to make hard decisions to step away from money. So.
Certainly, and to that point, I think it kind of brings up a couple of interesting avenues of different things I may want to ask you, or that when you have someone, you obviously have to understand the person you're dealing with. Again, just because someone's sophisticated and they understand, let's say binary options and investing overseas and doing all sorts of crazy stuff, when it comes to private placements in the United States, maybe they're not as well versed, or maybe this is, maybe they have a bunch of money from being, being a W-2 salesperson, and they are, they've sold IBM, they went the Ross Perot route, and they sold IBM computers and made billions of dollars, but
sure,
this is a new space for them. How do you necessarily approach someone that has either very little experience in the private investing world, or has a lot of experience somewhere else in investing, but again, they lack experience in the type of investment that you're going to be coming in. What are some things that you want to make sure that that investor understands? Because there's probably a few things, maybe whether it's understanding what a lockup is, what exactly the return metrics are. What are, again, some high level things that you really want to make sure that investor understands, kind of no matter where they come from, or maybe some things that certain people need to be educated on versus another group?
Yeah, I think it's a really good question. Depending on the sophistication level of the person that you're talking to, I think it's important to match the conversation to the type of vocabulary, the type of conversation that they can comfortably have. So if we have somebody that is not very complicated, or is not like a numbers person, I'm not going to get into the details of cost segs and tax benefits and K1s and all of those types of deals in the first couple conversations. It's going to be multiple conversations before we get to those. I think it's important to take a look at, essentially, I will go like as elementary as, going through the whole syndication model, walking through what that process looks like, literally step-by-step instructions on here's what makes sense to look for in your due diligence process, all the way to like literally here's how you wire funds to any detail along the way. So it really, again, just comes back to the level of sophistication of the person that you're talking to, and make sure to match and share enough information with them that they're being educated, but not too much to overwhelm them, and understand that sometimes it's going to take multiple conversations, and it's going to take a hand-holding with one person where it might not take as much hand-holding with another. So,
yeah, no, absolutely. Now, are there any points that you make sure to tell anyone, irregardless of kind of where they come from? Is there kind of one core thing that you always want to make sure your investor knows and understands? Or again, is it really kind of just going back to the point you made of like, you really have to understand who you're talking to and, what exactly you want to tell that person versus another?
Yeah. So in every investor I speak with, I want to make sure that they understand these are illiquid investments, meaning you can't invest your dollars and then ask for it back in 30, 60, 90 or 90 days or 2 years. Like, you truly are a passive investor sitting on the guidelines, and they are stewards of your dollar and responsible for it. And you don't have any voting rights in what they do with it once you wire those funds across. Okay. So first and foremost, it's illiquid. Secondly, it is important to share, although it's highly unlikely, it is possible to lose all of your invested capital in this deal. Like I said, it's highly unlikely, but there are situations, especially today, where we are starting to see that. So I will not take somebody's last $25,000 or $50,000. I don't want that on my conscience. I don't want, in the highly unlikely situation where something were to go negative, I don't want anybody to go bankrupt over an investment that they have with me. So I want to make sure that they have the financial wherewithal to support this type of investment and any negative consequences that can occur. So illiquidity and like the true potential risk are the two main things that I want to make sure that every investor knows before we move forward with an investment.
Sure. Now, let's say you've kind of gotten through that and they seem like a good fit. How at what point do you kind of just turn them back to at least from your opinion, is it something where, again, is it case by case specific for the people, or do you are you one of those people that likes to be hands on until the check gets delivered to you, or do you kind of like, again, and I think there's some benefit to both avenues of saying, hey, let me turn this back over to you so you can be making some of these decisions on your own, not be handheld, and really kind of, understand that you have made these decisions on your own without feeling like you maybe were steered in a certain direction. Any thoughts
Sure.
on that, and when you kind of want to say, hey, we've given you the information, you take it, digest it, make your decision. How nuanced is that, or is there kind of a good, buffer of saying, hey, like these people kind of need to be left alone, these people need to be handheld, or where do you kind of find the happy medium there?
Yeah, I mean that's a great question, and I hate to keep going back to it. Depends, but it does depend, right? So I might have an investor who's invested in other deals before, they understand the process, and it's as simple as, let me send you over the deck. Be sure to watch the webinar. And if you're interested, press the soft commit and move forward into the portal. Other folks, it could be to where I'm sending them to other resources and I'm introducing them to communities, or I'm suggesting other podcasts that they should listen to. So it just really depends. But, generally investors that have an interest will share that somehow. There's some type of buying signal that occurs, and then it's just really kind of agreeing on the next step. So like at this point, here's what I'd suggest. Why don't you watch the webinar that we've done? It's about an hour long. It's going to walk through every single thing that we're going to be doing in this business. And it's probable that you're going to have a lot of questions after you watch that webinar. So come back to me and let's talk about those. And let's do that next Tuesday at 2. And so just giving them steps with action items to work on, and then having a commitment for the next step on when you regroup to review the next steps.
Yeah, I think that's a really good point you brought up of the action items. I like to do that, with my prospects as well, is that, I can give someone, every ounce of information, but I feel like it's really important, especially in this space, is to make sure that the client or the prospect really kind of has done some of their own homework, so that way some of it's put back on them, because, whenever you've done the research, I feel like you get a better sense of ownership of what you're doing, and understanding, good, bad, or indifferent, what happens, I am kind of steering the ship. I think that's really important. Now, are there certain things that you like to, again, punch list out and say, hey, do your research on this? Or is again, just kind of general and saying, hey, we've given the information, just research what I've told you, make sure you read the PPM, make sure you read the prospectus. Again, you don't want to get into the issue of if they come back with, a 5-page document of saying, hey, here's, question from page 1 and page 3 and page 60, but again, do you kind of just turn them back? Any specific things that, from someone saying, okay, I like that, what are some things that I should make sure that they go back to? Or again, is it as simple as just make sure you read the disclosures and understand them?
Yeah, no, another great question. So as far as the PPM is concerned, I will always encourage, and I think anytime you're presenting something that's complicated, if you share some of kind of the bad news or the scary stuff that they're going to find and actually draw their attention to it, I think that actually helps in that process. So with the PPM, I will always encourage them to read through the full document and sometimes make a joke on, grab a glass of wine and sit down on a Friday night with a 100-page document. It's a lot of fun, right? But a couple of things that you're going to want to draw your attention to are take a look at the fee structures that are involved here. Here's where it lays out what we're making, because this is not just something that we're doing because we really enjoy looking at legal work and doing all this stuff. We're making some money on this as well. So be sure to look at the fee structure to see how that's structured. Be sure to look at the terms. Be sure to see the ownership structure, and then point out 3 or 4 or 5 points to them that you can then reference in the future after they've reviewed it. And that takes a little bit of, kind of the overwhelm of the document. It takes that out of it. It also makes you look like somebody who's not trying to hide anything as well. Draw their attention to it. I'll often say, the PPM is built by my lawyer, so it is there to protect me. Sure, it is also there to protect you, but it's my lawyer that's crafting this, so it's more so to protect us and the entity. But it is important that they understand what it is that they're signing. So those are just a couple of things that I do with the PPM, but I think instead of trying to push things by and hope that they don't see stuff, I think it's better to draw their attention to anything, because there's nothing worse than somebody making a decision to do something and then coming back later and saying, that they felt that they were manipulated, or they didn't realize what they were signing, or they didn't have any idea that there was, K1s could potentially keep them from getting their taxes done until later, whatever it is. Try to share all that information so there's no surprises, because surprises and lack of communication are the two things that investors hate more than anything in the world. So.
Yeah, absolutely. And I think a few things that, I kind of like from that are, one, bring their attention to where other people are making money, and the fact that their capital is supporting, other people, making money, and so far as it is fees, how the returns are paid out. It's a very good thing to bring up. I never quite understood, if you're making money in a deal, obviously, there's a limit to that, but, the fact that, the people that put together did a lot of the legwork, were also making money and potentially making a higher, well, they in an ideal world, they would be making more money than the passive people because they're putting in more work, more man hours, more X, Y, and Z. But
Sure.
definitely bringing that to people's attention because I've seen, back when I was, hands-on doing investments for clients, especially in the wholesaling realm, people get really mad when someone makes a ton of money on a deal, which I never understood. And, I'd look at something and be like, you made 15% in like 20 days on your money just because they doubled their money. Why are you angry? Like, but again,
Yeah.
I think they were angry just because they didn't know or wasn't necessarily explained to them as well. Because, you tell me I make 15% in 30 days of my capital, that person could triple their money. I'm
Yeah,
good.
sign me up.
It's like I'll do that.
Yeah.
If I can do that, 20 times in a year, we're good. We're
Yeah.
fine.
Yeah.
But again, bringing people's attention to that because especially if you're not involved in this world, those are some things that just people aren't used to. You're used to kind of saying, oh, like I made X here, and you don't really see how the bank made money on the back end. You aren't used to kind of seeing it, front forward of saying, hey, these people are making management fees. They're also getting, here from, a 70-30 split when it comes to, after the pref is paid out, how they're making their money like that. You say 70-30, it's like, well, that seems a little, weighted in a different direction, but there's reasons for that, and bring people's attention to that, I think, is very important. The other thing I think you brought up, but again, I think I kind of maybe I'm colored a little bit for the reason that I think this is important is the taxation issues of understanding, saying, hey, if you're invested in stuff like this, K1s, are not necessarily furnished at the same point as some other documents might be. There might be some delays. You might have to file an amended, or you might have to file an extension to do your normal tax return. And if people aren't used to doing that with some of the different ways that this stuff is paid out tax-wise, then you should definitely understand that.
Yeah.
Again, not necessarily getting into the weeds of making sure that they understand exactly how pass-throughs from something like a cost seg or accelerated depreciation affects their return on K1, and obviously being a different class of investor, whether you're an IRA, a 401k, a trust, an LLC, an individual, all those things can kind of build in. I think it's, again, and correct me if I'm wrong, but I would say from someone starting out new, it's good to have at least a working understanding of that, but knowing where to refer someone out to a CPA or a tax advisor is good. Knowing enough to be competent, but also understanding that there's a fine line for giving tax and legal advice there as well.
Right.
So, yeah, go ahead.
And Alex, I think you bring up a really good point. And I kind of have this like 5-step process I share with people that want to be capital raisers. And like the very first thing that I suggest to people is go invest some of your own money in deals. Like, there are things that you do not know about how this works until you've invested your own dollars and seen what happens when you've got to file an extension and you're not getting your $7,000 back at, April 16th, or what it's like to get, or what a K1 even is, right? All of those different types of things that come into it. So first and foremost, people buy from people that they know, like, and trust. And the best way to build trust is to have a story that shares how you've leveraged what it is that you're trying to get them to use anyways. So I always say, invest in some deals and spread your money across some different operators, not only in your own deals. See how other people operate, because things are very, very different depending on who the operator is and the asset class and the business model, all of those things, so you can have a really educated conversation with the investor on what they can expect.
Yeah, and I think that's kind of, because we're getting up towards the end of part one of this. You said you had 5 things, so I think that might be a good way to kind of wrap this up. Is that
Sure.
One, you said invest some of your own money in this, and I think that's a really great thing because if you're if you're talking to someone, it's like, hey, like, what's your experience in this? Oh, I don't do any of this. I just invest in stocks, or I just bury my
Right.
gold in the backyard. Then it's like, okay,
Right.
great. So you're selling me something you don't even believe in. So like having a working understanding, and when you say working, a hands-on approaches, like have done this, be able to understand, so that way you can come from a place of empathy, not sympathy. It's like, hey, like, I understand what you're going through. I have done this. Here's how I overcame it. Here's what I looked at, because I have done this too. I've been in the same boat. I think that's a great kind of point one. So what are some of the other ones, again, the other 4 that you would tell someone?
Yeah, so really quickly, invest in your own deals. Secondly, once you've done that, create like an example deal that you can share with your network that you already have a pre-existing substantive relationship with. Like, create and just take one of the deals that you've invested with and pull off all the branding from whoever the partner was, or dumb it down to 5 or 6 different slides, and then start sharing that with your network. and just simply say, like, if I come across a deal that looks similar to this, is this something that you'd be interested in investing in? And if you get $500,000 to $700,000 worth of, soft commits, or 15 or 20 people that say that they would, now that becomes your asset that you can go take to operators and say, I've got approximately $500,000 to $800,000 that I think I can bring to a deal. Can I partner with you? And it doesn't have to be any more complicated than that. Then basically having that discussion with your network, getting the soft commits, and then going to find a partner to go do a deal on that like, and trust already. So that's it.
Great. Awesome. Well, I think that's a fantastic place to end up part one of this. For all of you that are listening, we will be doing this as a two-parter. First part being strictly focused on the the best practice when it comes to raising capital and things to watch out for and how you can branch into that. And then the second part will be focusing more on structures. So, Brandy, thank you very much for agreeing to be part of this two-part series. Again, my name is Alex Perny. This is the Alternative Investing Advantage podcast. Make sure to tune in for part 2 coming next week. Thanks.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.